Hi there, Robert Wolf here with Terra Firma Business and Financial Consultants. I'm an asset coach and a tax strategist. So today we're going to have another article talking about the Fed, talking a little bit about inflation, and really the focus is more talking about the Fed and their decision to reduce the purchasing of debt and such. So let's go through this article. Before we do, if you haven't subscribed to this channel yet, go ahead and hit the subscribe button, hit the little gray bell so when we do updated videos and content, you get notified. Also, if you like what you hear, give us a thumbs up. If you have any comments or questions, concerns, thoughts, please put those in the comment section as well. It helps us improve the content that we provide. And remember, the focus of this channel is for business owners to understand what's going on out there and in what we call economic termites. There's 5 major economic termites. There's taxes, inflation, time, laws and regulations, and debt. And so this channel will talk about various topics within these economic termites and geared toward, again, business owners. So let me go to minimize myself and let's go through this article that we have found. So the Fed in no hurry won't give signal on tapering. Well, they kind of do, but this was as of July 23rd. Central bank will begin to lay the groundwork for a change in its bond buying program. For you, those of you that don't know, one of the features that the Fed uses, and this is as of 2008 in the financial crisis, and they've been doing different things, quantitative easing, bond buying programs, that kind of stuff. They use different terms, different tools. And instead of using just interest rates, they found that they have other things that they can do. The Federal Reserve is expected to have a lengthy discussion this week about slowing down the monthly bond purchases that are so important for financial markets. So let's think about this for a second. Let's just talk about what it means for the Fed to buy bonds. Whose bonds? The government's. Congress. The U.S. Well, why does the government issue bonds? To raise money. Yes, this is debt for the country, but it raises money that makes up the gap from tax revenue and their expenses. So if they don't have enough tax revenue, which is the income for the government, and their expenses are above the tax revenue collected, what do? They borrow money. How do they borrow money? They issue bonds. Okay? And so what's the Fed doing? Buying these bonds. Well, what's the Fed do? They print money. They control interest rates. So if they're buying government debt, see what I'm getting at here? So it's a bit interesting. It's kind of a shell game. It's not really interest rate driven, but it kind of is, right? Because they're buying debt. They're not printing money, but they're just buying debt, which is kind of like printing money. But anyways, let's go on. And there's a bunch of information that they're hearing and talking about, blah blah blah, about the article, about the meeting and all this kind of stuff. But then we get into, since the pandemic hit, the Fed has kept its benchmark interest rate close to zero, which is true. And that actually hasn't been since the pandemic. That actually was since 2008. And it would crept up a little bit over the last, since 2008 to 2020. But then what's it done? In 2020, it dropped down a little bit. It's dead close to zero. When it was clearly last year that the economy was going to have a largely shut down to the combat the pandemic, the Fed stepped in and bought trillions of dollars of government debt to settle financial markets. Bought trillions of dollars of government debt to settle financial markets. Let's let that sink in. The central bank eventually slowed down the purchases last summer to a steady pace of 120 billion each month, consisting of 80 trillion in treasuries and 40 billion in mortgage-backed securities. Okay. Last December, the central bank said only that it wouldn't slow the purchase until substantial progress has been made toward the central bank's goals of a healthy labor market and stable 2%. How's that been working out? Right? We'll talk about inflation in a second in the article. Monetary policy hawks on the Fed Policy Making Committee downplay this requirement and want the central bank to start the process sooner rather than later. Well, yeah, because it's no different than just printing money and putting money into the market. They're buying bonds. Essentially, that's what they're doing. They're covering the government's debt, right? So you can read all this, but then here it says economists generally agree that the Fed won't raise its benchmark interest rate until after it has stopped monthly purchases entirely. So they're saying that the Fed's not going to raise interest rates, which Powell's been doing a very good job of being steady and saying, well, let's see, let's just wait for the data, which I agree to. I agree. Let's not emotionally make decisions like a lot of the media is trying to get the Fed to do. So I appreciate him saying, hey, time out. Let's take a look at things. But they're saying not until they stop purchases entirely. I don't think they'll ever stop in purchasing entirely. I think they're going to use both tools now. Slowly raise interest rates and reduce the buying. Because what happens when interest rates go up? The markets get affected, right? And so debts become more expensive, which who has the debt? The government has a debt. Who's printing money? The Fed, right? And so technically, if the Fed is buying debt, they should be paid the interest. So it's going from one hand to the other, but it's still the same body. That should take about 8 months for them to occur, the slowdown, or to stop entirely. Again, I don't think they'll entirely stop. But I could be wrong, right? I'm not an economist. I'm just some random dude who talks and looks at this stuff and try to look at it from a different viewpoint. The big picture is that the Fed monetary policy remain easy until its benchmark rate has moved well above zero. What's that mean? What's well above? Is that 2%? Is that 0.5%? Is that 5%? I don't know. What's well above? Underneath the Fed's discussion this week is growing unease among many economists about the Fed's flexible average inflation targeting, the strategy that was adopted last year. As part of this new strategy, the Fed promises to wait for actual data and not move on forecasts. Again, I agree with that. I agree with let's look at data, let's see what things are how things are going. But this flexible average inflation targeting, it's like they make up terms and things to justify what they are or aren't doing. It's really odd, isn't it? This seems like an appropriate strategy when inflation was low, but inflation has roared back this year to its well above 2% target. The consumer price index jumped 5.4% pace over the last 12 months ending in June. That's true, right? So we're pretty close to a triple of the target, right? Economists are having trouble squaring how the central bank will react to this higher inflation given its new approach. Powell said higher inflation is I love this one. Transitory, but there is growing sense that it could stick around. Well, duh. When you have people like a Warren Buffett, and I said this before, saying, well, the market, the consumer is okay with price hikes. I'll say it again. We're not okay with price hikes, but we got to live. We got to eat. We got to drink. We got to get to and from work. Those of us that are going to work, right? The bottom line will be that the Fed is moving to take its foot off the gas. Again, I think it's not necessarily going to take its foot off of the gas. I think it's going to go to a cruising altitude where it's going to focus on interest rates and the buyback. Okay? That's what I feel like. And then once interest rates are comfortable to getting, and people, you and I, consumers, are comfortable with interest rates between 4 and 6%, then I think at that point they'll be completely off the gas pedal and no longer buying back. But with the stimulus packages and the government creating trillions of dollars in debt and such, I don't know if they'll be able to. So that's a question we all have. Which, and as business owners, what do we do? Well, that's some of the other things that we do as a strategies in our practice and things that we look at trying to help business owners with cash flow. And whether inflation will force them to move at a faster pace than it's currently anticipated, that is a question for another day. Correct. This inflation episode is very different from what we've had for decades now. I completely agree with him. 100%. We have never seen this before. This is a concern. This is something we can't look at history. And I think this is where Powell is taking the right action of seeing and waiting for data. You can make the argument you wait too long, the damage will be done and it'll take a while to recover. True. But the opposite could occur. If he acts too soon, it could cause repercussions as well. Okay. And so I think he's accurate. Now, how long will he wait? What kind of actions will they take based on data? I don't know. But we've got to understand, folks, we are in an unprecedented time. When was the last time the world economy just stopped? Right? The Black Plague? Right? I don't know. When was it? And was it a world economy? Right? So we're in a situation now that I think is very, very sensitive, and we need to be aware of this. So anyway, so hopefully this was helpful. The article will be, the PDF of the article will be in the comment section down below. And again, if you haven't subscribed, go ahead and hit subscribe. If you like what you've heard and you want to get updates on new materials, new videos, new content, if you like this, give us a thumbs up and add some comments below. We'd be happy to address and improve the content that we provide to you. And if this is if you want this and more. All right. Thanks so much, guys. Make it a great day. Bye-bye.